Hello everyone, my name is Shouvik Pandey and my ID is 221001101086 with my team member Chetna Kumari Singh with her ID 221001075001 and we are here to talk about marginal costing. Introduction to marginal costing. First, definition. Marginal costing is an accounting technique where only variable costs are charged to product cost while fixed costs are treated as period cost. This method focuses on the incremental costs of producing one additional unit of output. Second, importance. First point, decision making. Marginal costing helps managers make informed decisions about pricing, production, and profitability by providing insights into behaviors. Second point, cost control. By focusing on variable costs, businesses can better manage and control costs that fluctuate with production levels. Third point, performance evaluation. Marginal costing aids in evaluating the profitability of products and segments by analyzing their contribution margins. There are some key concepts of marginal costing. Marginal cost definition: the cost incurred to produce one additional unit of a product. Formula: marginal cost is equal to change in total cost by change in quantity. Example: if producing 100 units cost $1,000 and producing 101 units cost $1,010, the marginal cost of the 101 unit is $10. Second, variable cost definition: costs that vary directly with the level of production. Example: direct material, direct labor, variable manufacturing overheads. Behavior increase with high production and decrease with lower production. Third, fixed cost definition: costs that remain constant regardless of the level of production. Example: rent, salaries, insurance, depreciation. Behavior: do not change with changes in production volume within a relevant range. Fourth, contribution margin definition: the difference between sales revenue and variable cost. Formula: contribution margin is equal to sales revenue minus variable cost. Importance: indicates how much revenue is available to cover the fixed costs and contribute to profit. Fifth, break-even point definition: the level of sales at which total revenue equals total cost, resulting in no profit or loss. Formula: break-even point units is equal to fixed cost by contribution margin per unit. Use: help determine the minimum sales volume needed to avoid losses. Sixth, cost volume profit CVP analysis definition: an analysis to determine how changes in cost and volume affects a company operating income. Components: sales price, variable costs, fixed cost, sales volume. Purpose: helps in understanding the relationship between cost structure and profitability. 7. Period cost definition: costs that are expensed in the period in which they are incurred out rather than being assigned to products. Example: administrative expenses, selling expenses. Treatment: not included in product cost under marginal costing. Marginal costing versus absorption costing. First, overview. Marginal costing. First point, only variable costs are included in the cost of goods sold. Second point, fixed costs are treated as period costs and are expensed in the period they are incurred. Absorption costing. First point, both variable and fixed manufacturing costs are included in the cost of goods sold. Second point, fixed costs are allocated to each unit produced whether sold or not. Second, key difference. Basis. Cost allocation. Marginal costing. Fixed manufacturing overheads are not allocated to products. Absorption costing. Fixed manufacturing overheads are allocated to products. Basis. Profit calculation. Marginal costing. Profits can vary with changes in inventory level because only variable costs are considered. Absorption costing. Profits can be distorted by changes in inventory level because fixed costs are spread over units produced. Basis. Inventory valuation. Marginal costing. Inventory is valued at variable production cost only. Absorption costing. Inventory is valued at total production cost. Example, variable plus fixed. Here are some examples.
Components of marginal costing. Variable production costs. Definition is costs that vary directly with the level of production. Example, direct materials, raw materials used in production, direct labor, wages for workers directly involved in manufacturing, and variable manufacturing overheads, costs like utility and supplies that vary with production volume. Variable selling and administrative costs. Costs that vary directly with sales volume are variable selling or administrative costs. Example, sales commissions, payments to sales staff based on units sold, shipping costs, costs to deliver products to customers, variable administrative expenses, costs that vary with sales volume, such as office supplies and utilities used in sales and marketing departments. Contribution margin. The difference between sales revenue and variable costs is contribution margin. The formula for contribution margin is sales revenue minus variable costs. Importance. It indicates how much revenue is available to cover fixed cost and generate profit. Fixed costs. Costs that remain constant irrespective of the level of production or sales. Examples, rent, cost of leasing manufacturing facilities or office space, salaries, fixed wages for administrating and management staff, depreciation, allocation of the cost of long-term assets over their useful lives. Treatment in marginal costing, treated as period costs and are expensed in the period they are incurred, not allocated to products. Marginal cost, the addition cost incurred to produce one more unit of output. Formula for marginal cost is change in total cost divided by change in quantity produced. Example, if total costs increase from $10,000 to $10,500, when production increases from 1,000 to 1,100 units, the marginal cost of the additional 100 units is $5 per unit. Calculating contribution margin. Contribution margin is the difference between sales revenue and variable costs. It indicates how much revenue is available to cover fixed costs and generate profit. Formula for contribution margin is sales revenue minus variable costs. The formula for contribution margin per unit is selling price per unit minus variable cost per unit. And the formula for contribution margin ratio is contribution margin divided by sales revenue. Break-even analysis. Break-even point is the level at which total revenue equals total costs, resulting in zero profit or loss. It's the point where a company covers all its fixed and variable costs. Formula for break-even point is fixed cost divided by contribution margin per unit. Example, suppose a company has fixed cost of $50,000 and a contribution margin per unit is of $10. The break-even point in units would be 5,000 units, that is $50,000 divided by $10. If the contribution margin ratio is 40%, the break-even point in sales dollars would be $1,25,000. That is $50,000 divided by 0.40. In conclusion, marginal costing is a fundamental concept in accounting that offers valuable insights into cost behavior and aids in decision making. Throughout this presentation, we have explored its key components, including marginal cost, variable cost, contribution margin, and break even analysis. We have seen how marginal costing facilitates better pricing decisions, assists in determining the optimal product mix, and supports special order decisions. Moreover, we have discussed the advantages of marginal costing, such as its simplicity and its ability to provide relevant information for decision making. However, it is essential to acknowledge its limitations, such as the assumption of fixed costs and the exclusion of overheads. By understanding and applying marginal costing effectively, businesses can enhance their profitability and make informed strategic choices. As we move forward, let us continue to leverage the power of marginal costing to drive sustainable growth and success in the dynamic business environment.